And Thomas, we will present you the Dorsey and Gamby investment management case as part of the Financial Open CFA Societies Canada Ethics Challenge. For our agenda, today we will analyze first the current situation, then analyze the case, give our recommendations, then the limitations of our strategy, the benefits and challenges of our proposition, and finally, we'll finish with the key takeaways. Our mandate is to evaluate past violation of DGAM in order to identify some potential improvements for the firm. And finally, we will present you our effective implementation strategy. To analyze this case, we decided to separate it in 4 parts. First, we will give a bit of context about Dorsey and Gamby and their relation to their clients, and then analyze their partnerships with their relation with their partners, with the snake fund Skip Madison and Ford Woodman. On the right-hand side of the screen, you can see some of the aspects we will cover in this case.
All right, so thank you so much for the introduction, Tom. As mentioned, my name is Isabella. It's lovely to meet all of you. I'll begin by going over some of the ethical violations that my team and I observed at DGIM. We'll begin with relations to clients, most specifically how it was communicated to clients that Miriam Gamby would be retiring. Now, rather than actually conveying this in a very transparent and truthful manner, DGIM actually kind of overstated Jack Dorsey's previous investment experience, as well as Miriam Gamby's future involvement in the firm. So this is really a violation of CFA Standard 1 professionalism, D misconduct. And that's because they're really engaging in this deceitful and dishonest behavior regarding the professional activities within the firm. Not only this, but as the investment managers for their clients, they have a fiduciary responsibility. They're in this elevated position of trust where they're supposed to act in the benefit of their clients. In this situation, they're not doing that. So this is in violation of Standard 3, duties to clients, A, loyalty, prudence, and care. Here we really want to highlight the importance of care, not causing our clients harm. In this instance, with Jack Dorsey coming in to be CIO without the experience he claims he has, this is really exposing these clients to some additional risk and potential harm in the future. And that's why this is a violation as well. Next, we had the Snake Fund. In this instance, DGIM conducted less interviews, reference calls, reviews of company codes of the fund because of previous relationships with some of the employees. Now, this is in violation of CFA Standard 5, Investment Analysis, Recommendation, and Action. A, diligence and reasonable basis. It's clear that they've cut corners here. They don't have a reasonable and adequate basis for their recommendation. They didn't conduct the research and investigation as thoroughly as they could have. In addition to this, DGIM is very much known for their rigorous due diligence protocol. In this instance, they really deviated from that. So that deviation from this process needs to be communicated to clients. When that process of conducting due diligence changes, clients must know. Because at this point, when they look at the evaluation of the Snake Fund, they assume it's been conducted as every other evaluation of a fund was, which isn't true. Next, we have Skip Madison. In this instance, there was a misrepresentation of returns. Now, this not only violates CFA ethical standards, but also GIPS standards as well. So statistical data was collected, it was deemed erroneous, but rather than correcting it, DGIM and Skip Madison actually marketed it to clients for their own benefit. So this is in violation of CFA Standard 3, duties to clients, D, performance presentation, as well as CFA Standard 1, professionalism, C, misrepresentation. They've presented this expected return in a very misleading manner, and they're not being truthful about the accuracy of the report. As the fiduciaries, DGIM have a responsibility not to expose their clients to such a product. And finally, we had the Ford Woodman case. In this situation, we saw a lot of the same violations reoccur, the modification of the strategy without informing clients, failure in conducting diligence for clients. However, what's interesting here is this acting on non-public information. So upon receiving information, we were able to deem that it was actually material. Once it was released to the general public and disseminated, it had a real material impact on the price of the stock. So we know it's material for that reason. A non-disclosure agreement was asked to be signed. So in acting on this information and selling the stock for themselves and for their families, DGIM violated CFA Standard 2, integrity of capital markets, A, material non-public information. Now, a nuance we also want to highlight in this point of the case is that even if this information had been public and non-material, it still would have been a violation. Now, why is that? Well, as the fiduciaries, there's a transaction priority for your clients. If you receive information and you want to act on it, your priority is to do it for your clients first before you do it for yourself and your family as well. So that's another nuance in this part of the case. Now, what are the implications of all this? Well, the duty here is to clients, and that's for sure the primary consideration with this case, because with all these violations occurring, if we look at this on kind of a larger holistic scale, it really impedes investor confidence in the markets and can deter people from investing. And that really makes the markets more costly and less efficient. In addition to this, it breaches client trust, which can cost DGIM current and future clients. Not only this, it negatively reflects on the professional integrity of both DGIM as well as CFA Institute as a whole. I will now pass it on to Thomas, who will go over our implementation strategy.
Thank you, Isabella. So after conducting our analysis, we were able to come up with a recommendation strategy that is split into 3 different sections. The first part will take part in the first month and will be focused on the critical actions that we need to make to remedy the recent violations. The first one of those being that DGIM needs to disclose the capital lockup fee that they receive from the master funds they invest into, as this fee has been previously voluntarily non-disclosed to clients. Next, they need to address the Chief Investment Officer change properly by informing correctly of Gambi's retirement and the move to a passive role, and by also mentioning Dorsey's appointment as Chief Investment Officer and not Co-Chief Investment Officer. Next, they need to remove their feeder fund from Barson-Stevens ILSD product, as this product is in breach of the GIPS by promoting erroneous financial data. They need to remove, they're in their responsibility not to expose their clients to this product, since it's in breach of GIPS. Next, they need to conduct the appropriate due diligence on both the snake fund and the WIEF fund. They need to inform clients that a decision was not taken according to the established model that is promised to clients for the snake fund. Next, they can run the due diligence on the snake fund and WIEF, and if according to the standard of suitability, those products are still appropriate for clients, they can keep offering them. And they also need to send a letter clarifying Ford Woodman's current strategy to clients to ensure transparency, as Ford Woodman has modified his strategy without mentioning it to clients, and the clients have a right to know. The next period will be focusing on intermediate improvement by reinforcing the CFA Code of Ethics within the company. As a company has a lot of CFA charter holders within it, we feel that doing a company-wide review of the CFA Institute Code of Ethics will provide a good refresher to ensure compliance. We'd be working on doing workshops to review past violations and showing the downsides of ignoring the Code of Ethics so that this is more tangible to them. We would also clarify policies in place, specifically regarding non-public information and personal trading, as this will limit the risks of conflicts of interest in the future. For our long-term objectives, we would be focusing on strengthening the alignment between DGIM's actions and the company's strategy. Since DGIM is a firm that prides itself on doing more due diligence than the average market firm, we feel that doubling down on ethical decision-making will really help them capture that market share and allow them to develop their client trust even more. We feel that they need to reaffirm their thorough due diligence protocol by implementing a verification protocol that will reduce the risks of this due diligence not being delivered to clients. Next, we'll look at expected benefits and potential downfalls of our solution. Now, for benefits, we do expect that our strategy will bring about operational efficiency and safety for DGIM and help them in building trustworthy relationships with their clients. In turn, we expect that building those relationships of trust will help drive customer retention and engagement. And on a more general note, we do expect that our strategy will lower the overall risks for the company, mostly regarding lawsuit and reputation risks, as well as product-related risks through the increased due diligence. However, it's important to notice that the increased compliance can have some downfalls for the company. The increased due diligence can cause some stickiness in investment decisions and decrease the speed of operations. Also, a restrictive non-public information policy can make relationships with partners more tough to manage. And also, the loss of freedom of action and the impossibility of personal trading can demotivate portfolio managers and make it tougher to attract top talent. Here are some key performance indicators that we highlighted that would be good to monitor for our company to manage to see if our performance of our strategy is doing well. For client trust, we have customer retention and the number of customers. And for market reputation, we have client referrals, average client wealth, and above average returns.
Thank you very much, Thomas. Now we'll be giving the key takeaways of our presentation. So in order to protect clients, employers from misconduct, as well to reduce risk of future violations, DGIM needs to increase its compliance towards the CFA Code of Ethics and professional conduct. And we believe our strategy in 3 steps will improve operational efficiency and safety, create a more transparent environment between investors and client, and last but not least, reduce legal risk. Thank you very much to the people who made this competition a possibility, and we'll now open the floor for questions.